hide your kids, lock the doors. You're listening to HR's most dangerous podcast. Chad Sowash and Joel Cheeseman are here to punch the recruiting industry right where it hurts. Complete with breaking news, brash opinion, and loads of snark. Buckle up, boys and girls. It's time for the Chad and Cheese Podcast.
Oh, yeah. What's up, boys and girls? It's your favorite guilty pleasure, a.k.a. the Chad and Cheese Podcast. I'm your co-host, Joel Cheeseman. Joined as always, Chad Sowash, and it is time again for our data podcast as we welcome the Bigfoot of big data, the Loch Ness of knowledge, the Sasquatch of statistics, Toby Dayton, CEO at LinkUp. Toby, welcome to HR's most dangerous podcast.
There he is.
So what's happened since we last talked? Has anything happened? Anything weird with the markets?
You've been taking
going on?
like 37 vacations since the last time we've actually been on a podcast.
I've missed Toby.
Toby and I have been doing stuff around this place. We've been doing stuff, but yeah. So anyway, when it comes down to Joe's got a great question, but I want to try to pinpoint it a little bit.
Mm-hmm.
We got some selections happening in the presidential election. Do you think that's actually going to make any difference in the markets whatsoever?
Toby's neighbor, I think, right? Toby lives right next to you.
It is. We're very, very happy with a lot of news going on, and certainly Minnesota is now well represented. So yeah, no, we're excited. And to your point, Chad, and we're obviously biased, Minnesota, but generally, I think that yes, I would say, we're probably I would overestimate it a little bit just because of that bias. But
of course,
I think the momentum, the excitement, the enthusiasm, the positivity that has been injected into the campaign, the messaging, I think is just the whole tenor of the campaign, I think nationally has really changed. And I see that will find its way into consumer confidence, general sentiment, outlook. I think it is going to have an impact. I think it's going to grow. It started out, people are talking about when the honeymoon's going to, be over and sort of reality sets in. I would see this as it might come down a little bit from where it is, but it's then going to just keep, I think, growing and rolling out as things progress towards November.
Well, one thing that Tim Walz can't do something about was July. And this from the BLS kids. Total non-farm payroll employment edged up by 114,000 jobs in July, below the average monthly gain of 215,000 over the prior 12 months. In July, employment continued to trend up in healthcare, in construction, and transportation warehousing, while information lost jobs. Healthcare added 55,000 jobs in July, similar to the past 12 months. Employment continued to trend up in construction in July. Employment at specialty trade contractors continued its upward trend in July as well. Holy shit, Toby. Analysts have been predicting recession for over a year. Will this end or start the Chicken Little overdrive of economics that we're seeing? Is this justified with all the crazy recession talk?
Yeah, it was kind of a crazy week, and last week and this week in the markets, and there's a lot there to unpack. I would say generally from what we've seen in our data, and we actually forecasted a below consensus report. So this wasn't a surprise based on what we were seeing in our data. I think the market wildly overreacted. Obviously the timing around the Fed's decision to not move rates, and then the jobs report came out literally the next day, and sort of all hell broke loose in the markets and the reaction, and we're heading into a depression, and the Fed's behind the curve, and Armageddon is kind of right around the corner. I think that very quickly corrected itself, and as Bloomberg said this week, called it a sort of a market temper tantrum that was pretty short-lived, but
overreaction.
I think
it sounds like some of the pressers we've seen lately.
Yeah. so there, I think, leaving aside the markets, because I think that's a whole different discussion around the sort of the market reaction. I think generally speaking, the broader question of what this means for where we are is, I think there's some legitimacy to unemployment shooting up to 4.3. I think was kind of the thing that caught everybody's eye. The 114 is low. So I think that, that combination of those two, I think, is what sort of set people off. And those are numbers that are legitimately, warrant some analysis, some understanding, some context. And, from our view, we continue to be of the mind that the job market is very balanced. We've cooled off, but things are very, very balanced. We're in a very much a full employment environment, and all of those things are to be expected. Unemployment 4.3 is, it's trending up. It's sort of the baseline of where things are relative to historical levels. And then it's the trend line. And when those things are different, you get you just get a lot of people who kind of can't, they really get unsettled by a trend line down. But historically, things are this is very much normal and very positive. And so I think there's lots of people who are going to take the glass half empty view and, oh my God, doom and gloom. And there's the sort of balanced, measured, hey, historically things are really good. And you can just play that out and time will tell. Our view is, and again, we can unpack this a lot, but our view continues to be that this is exactly what the Fed's been trying to orchestrate, is this perfect soft landing, cool down the economy, get inflation under control, and keep things in a very positive state. And we're here, and it's actually a very, very good outcome.
So this is actually what the Fed was trying to get done.
Exactly.
LinkUp is the leading provider of deep, accurate, and actionable labor market data. Unique in that we only get job listings from the one source of truth, the employer's website. By going to the source, we avoid all the duplicate and expired job listings that plague job boards and thereby other job data sets. Our data offers the clearest window into employers of all types and sizes throughout the world for an ever-growing number of use cases and applications.
Toby, a couple things. Number one, politically, I'm glad Minnesota, we can finally take them off the board as a swing state. That was really in question. I'm sure the Dems are happy about that. The other thing is that I want to remind people of a prediction that you made earlier this year.
60% of the time, it works every time.
You had said that Trump and Biden would not be the nominees in this year's election. You were half right, my friend, which listeners know half right on a prediction is pretty good for a prediction on Chad and Cheese, which are mostly wrong. One of the things that doesn't get a lot of talk in the report is weather. Apparently, weather had a huge impact with hurricane season and storms coming through, fires. What's your take on that? Apparently, 461,000 people reported that they had a job but were unable to work due to the weather. With climate change, what's your take on the weather and the jobs report, if any?
Yeah, I've seen reports on both sides that say that it didn't have an effect, and others that say yes, it did. So I would. My general view is it's kind of unknown at this point how much. I think we're going to, when we see revisions to July combined with August, I think that's going to be very telling. Mm-hmm. Weather does come into play. And when you look at, the household survey, the survey response rates, they are based on the week of essentially the 12th, whatever week the 12th falls in. That's sort of the survey week. So if there is weather that's impacting that, and hurricanes are dramatic and can be, and I the I will never forget in 2018 the 3 hurricanes in one season, and it was just this constant barrage of hurricanes, and they do impact the numbers. I think that's part of what the market sort of reacted to get back on, off its sort of apoplectic state after the numbers
Come off
came
the
out.
ledge.
They came off the ledge and realized that, okay, there was weather. The temporary layoffs was also an anomaly, that temporary layoffs that spiked. And Goldman had some great research that said a lot of that was in Detroit around auto retooling in plants. So there are anomalies in those releases that you've got to, again, the headlines, everybody kind of takes the 5-second view and they see the headlines and then they kind of lose their minds and the markets react. But when you there's a lot of nuance to these things, and you've got to look at data, you got to understand it, you got to put it in context, and our view is take a moderated approach to it, because there's and the other baseline is one data set is one data release is I wouldn't say it's not irrelevant at all, but it is in the context of things. You got to put those into general trend lines are going to be far more impactful than any one data release.
Yeah, I love the headline that I saw all over the place was JP Morgan increases their chance or estimate of recession, which is a scary headline. But if you look at the story, they moved it from 25 to 35, which is still not exactly a high probability. So that's a great point in terms of media. Sometimes we get a little bit too excited and we have a gag reflex over some of these things that happen. Which is why we have this show.
There were, a lot of headlines of, oh my God, where the job market is in terrible shape, and how did we miss all the warning signs? And then you sort of read, even in the same article, you kind of get to the meat of the article, and it's like, we're still in full employment. 4.3 is really low. Working age population employment participation is at record high levels.
Mm-hmm.
But the headline is always going to be the thing that gets the clicks and it gets the attention. So
Don't know how many times I've clicked in and I've read the article and I'm like, this is nothing to what the actual headline was. What is going on here? Right. Yeah. So I feel that.
Clickbait.
Go back to one slide on that, because I think this is an interesting thing too, and this is really where I see a lot of where our view is very much informed, and I think this is also an interesting debate when we look at sort of our data, job openings data, and again, we're pulling job openings directly from employer websites around the world every day, so we've got real job openings directly from employers. We don't have job board data and other third-party data, really noisy, and job board pollution it makes for very bad signals. So we're looking at real job openings here relative to JOLTS data, which is the Bureau of Labor Statistics job openings data. And again, there have been times since the Fed started hiking in March of 22, there have been some really key differences. And over time, since, again, going back to 2019, you can see those things, our data tracks pretty closely to what JOLTS is over time. There are periods there where there are pretty significant divergences,
like this one,
and we're in one of those periods right now. And the other one was, going back to 23 when we said no recession. Everybody else, 100% of economists in 23 said recession by the end of the year. You look at that from January to pretty much most of 23, our data was flat or up, and that no recession ever materialized. And we're in the very similar period now where the JOLTS data is down almost 10% year to date. Labor demand, our data is, it's not up dramatically, but it's up 3%. And so that's a pretty big divergence. And we're seeing, and in the first quarter, one of the reasons why we said that we didn't expect the Fed to cut as much as the markets were is because we saw very strong job growth, very strong, healthy economy that was going to continue to propel very strong job gains, and sure enough, the first quarter came in, way higher on job growth than anyone expected, and the higher for longer became took a while, and it kind of rocked global markets. We see a similar kind of thing in a very short, sort of 48-hour period with the jobs numbers now, and markets kind of overreacted. So again, it is our view is looking at accurate real data and having a pretty good balanced context around things is going to give you a much better picture of what's actually going on.
Yeah, for the listener, I mean, Toby and LinkUp, they receive jobs, so signals on is it daily basis? Is it an hourly basis, a daily basis? Okay.
I mean, we're indexing jobs around the clock, but it's the data set it's a daily data set.
Okay, so you're receiving daily signals. Talk a little bit about the JOLTS data and some of the BLS data. What's the lag? What are we looking at there?
So JOLTS it is lagged at least, and it depends on the month and the release, but it's lagged by at least a month, and then it's also revised. So it depends on sort of that, and same thing with non-farm payrolls. It's revised 30 and 60 days. So our data is much more real time view into what's going on in the job market for sure.
Yeah, and this is just data from corporate career sites. So these are where the jobs actually start, really the source of truth for job openings, right? Versus being able to go out there and get all the jobs, which literally you have duplicates and scams and all that other stuff.
Yeah, it's sponsored jobs, ads, all kinds of stuff. The other thing that I think is really interesting, and we started looking at this balanced job market line. I mean, that's the other thing too. And we are very much in a full employment environment right now. And with unemployment even going up from 4.1 to 4.3, it's still full employment. And we're in this very balanced state. And it feels odd because it has been, you look at sort of the whipsaw of COVID and then this massive supply shock and then labor demand coming down as the Fed hike. Those sort of peaks and troughs are as dramatic as we've ever seen literally in our lifetime. So it feels very unsettling over the last 4+ years. But when you look at and go back to, and that balanced job market line, we have gone back to 2012. And it's very consistent exactly what that growth is. It's about labor demand going up about 5% per year. And you map that and you can just track it, whether it's the jobless recovery, full employment from 2015 to 19. You just map that line out and we're right there in a very balanced, and balance is for us is balance between demand from employers and supply of job seekers and candidates. When those are in perfect balance, you can have balance in a good economy or a bad economy. So balance by itself doesn't necessarily tell you much around what's the economic backdrop and GDP, but balance does tell a lot in terms of wage inflation, confidence, consumer, can people find the jobs? Is that balance between job openings and supply, job seekers? If that's in sync, it's a very telling indicator, and we're right there, which is again is in a full employment environment. When you have balance like this, things are very good. And again, that doesn't mean it's not going to change 6 months from now, but things are very good at the moment as far as the U.S. economy goes and the job market.
So when we take a look at 23, right, because there's this huge spike, right? If we take a look at the data here, there's this huge spike. Is that generally when we start to see the lag in wages stop lagging and then it starts actually moving with the market? Is that what we see historically, or does that take a bit to actually catch up as well?
Yeah, so wage inflation. So wages went way up coming out of COVID as employers basically just desperate to get everybody back to work, and the Great Resignation and all these things were happening. They raised wages like crazy. Wage inflation stayed pretty elevated even after the Fed started hiking in March in 22. Wage inflation was still pretty. It took time for that balance to come into play, and we have other slides and do webinars and sort of walking through this COVID era of what happened. But essentially, the market was way out of balance in post COVID, and then post COVID, and it took a good 2 years, year and a half, 2 years for that balance to occur, and wage inflation as employers finally started to fill those jobs that they desperately needed to fill. They got to the point where they could start not having to raise wages every month, every quarter, every new job opening. They had to raise wages to get candidates in to apply for those jobs and to fill those positions. That took some time and a whole subsequent series of cycles around filling those. So it did. There was a lag effect before that wage inflation started to come down, and we're now in wage inflation. Effectively it's dropped. I mean, wages are still elevated above where they were, and where they're going to stay, but the rate of wage inflation has come down. So it has moderated, but it took a while. You're right, Chad. It took some time,
Toby,
to get that
talking
equilibrium.
about the pandemic and the whipsaw and how things were so out of whack. One of the things that I've sort of kept my eye on passively is the commercial real estate market. And with work from home, back to, return to office, where are we in the process? The Wall Street Journal has had some fairly negative stories about commercial real estate. They had a story recently entitled "Office Loans Are Toxic, but Apartment Loans Are in bad shape too." They paint a pretty bad picture. But then when I look at your data, construction jobs stayed pretty strong, 25,000. It was right below, it was below healthcare at the number 2 position in terms of jobs. And if I look at your data, you show finance and insurance jobs up 4.4%. So on one hand, I'm getting Wall Street Journal telling me it's, Chicken Little. And I know it's the media, but it is the Wall Street Journal. It's a little more objective. Yeah. And then your data says something else. What do you make of construction, real estate, commercial? Like, give us your take on that.
Yeah, it's I would say generally it's kind of one ring out of, I've got a view on it. I will put a qualifier there that it's one step outside of our, anytime we sort of exit the job market and move into other parts around the economy or the capital markets. So with that qualifier, I will say one, we do track with jobs the correlation between labor demand, work, and certainly commercial and office real estate is huge. I mean, it is really dramatic, but it's also true even in residential and industrial and just general real estate. I think there's a lot of correlation there between the job market and what's going on in various pockets of real estate. I think I break those two up a little bit. On the commercial side, I think things have also normalized on the remote work. I think that generally it's just been a massive disrupting force there, the remote work, and everybody knows the stories around what's going on inside cities and commercial real estate, office real estate and vacancy rates are crazy high. I think that's going to take some time to work through. That is, how that affects capital markets. I'll leave that aside, but it is, I would say generally it's going to take, that may be one of the longer term impacts of COVID is the just tectonic shift in offices and vacancy rates in downtown areas around the country. And cities, I think, are still really reeling outside of a few cities where they have bounced back, faster than others. There are cities around the country that are just still having long-term impact there. On on the residential side, I think that is another massive structural imbalance between supply and demand.
Mm-hmm.
And I would say, generally speaking, one of the things that I think is going to we continue to be positive about as rates start to come down, and even without the Fed move, mortgage rates are coming down. The market is reacting even in advance of Fed moving down. That is going to, I think, the real estate residential is going to start to pick up again dramatically. And there is, I think that that supply demand imbalance is going to be a continuous lift on the general broader economy. I think there's just a massive shortage of housing and particularly affordable housing nationwide. And that is going to be I think a long-term buoy to general economic activity and job growth going forward for as far forward as people want to sort of extend that horizon.
Yeah, we've seen that happen in cities all over the world, pivoting to the global side of the house. So it's not just happening in the U.S., but it seems like the U.S. is actually handling this whipsaw better than the rest of the world. So can you help us out with that a little bit?
Yeah, it has absolutely been the case. I mean, I think the U.S. economy has been absolutely the envy of the world post-COVID. We continue to the GDP, job growth, general economic activity, the recovery has been incredibly strong. I think we, again, it goes back a little bit to the debate around the Fed, and should they have started cutting in July? Our view is, that certainly, I would have been very supportive of a first cut then, but taking the sort of central bank response aside, I think the U.S. economy has just by every measure has outperformed the rest of the world, just hands down. It's been incredibly impressive.
Much like the Olympics.
USA, baby. All right, Toby, thanks for talking all of us off the ledge. Give us a prediction for the next jobs report. What do you expect?
I would say, we've got to get all of August data before we're going to have a jobs number forecast for August. But generally, I would suspect that we continue to see this. We certainly don't see things falling off a ledge anytime soon. And
rate cuts? Any rate cuts?
And rate cuts, I think, not surprisingly, everyone is expecting, and we are very much in that camp. September is
that's become a political football too. That's interesting.
Yeah.
Trump is saying don't do it before the election, but he
Imagine
likes
that,
the attention
because it'll actually help the economy.
That's right.
But the question is that's the whole idea, is that it'll help the economy growth, stimulate growth again. It's interesting how we're trying to cool it down and then warm it back up. It just crazy. How fast do you think that'll actually impact the economy? Obviously, the markets, I think it'll be instantaneous. As soon as it's out there, the market's gonna explode. But the person in Minnesota, right, the next door neighbor to Tim Walz, right? When are they going to feel it? When's that family?
There's a lot of debate around that question. I think there are all kinds of things that different responses to that creep into the market in different cycles and time periods. So I think even the signal that a rate is coming in September can help. So it's already started to creep into, and mortgage rates have come down. So for anybody that is looking to buy or sell a home, that's already had an immediate impact. I think rates can affect, whether it's credit card, anybody that's got any kind of debt of any kind, there can be some pretty quick impact there. I think that generally then there's some longer term lag effects. So it sort of depends on what measure of how quickly does that find its way into real people's lives. But generally it has a positive effect, and depending on what, given household is, what their personal situation is. It can be short, medium, or long term before they start to see a benefit. Broadly speaking, though, there's just no doubt that cuts and sort of that imminent rate cut has already started to and will continue to have a positive impact on keeping things in this very good place.
And we love positive impacts. That is Toby Dayton, CEO at LinkUp. Toby, just a quick reminder, where can people find out more about LinkUp?
linkup.com. That's the best place to go and get a good overview of our data and use cases and blog content and all kinds of things about what's going on in the job
Keep
market.
up to date, people. Keep up to date.
Reading beyond the headlines, because we don't fall for the banana in the tailpipe.
You're not going to fall for the banana in the tailpipe.
Chad, that is another one in the can. We out.
We out.
Thank you for listening to, what's it called? The podcast. The Chad. The Cheese. Brilliant. They talk about recruiting. They talk about technology. But most of all, they talk about nothing. Just a lot of shout-outs of people you don't even know. And yet you're listening. It's incredible. And not one word about cheese. Not one. Cheddar. Blue. Nacho, pepper jack, Swiss. So many cheeses and not one word. So weird. Anywho, be sure to subscribe today on iTunes, Spotify, Google Play, or wherever you listen to your podcasts. That way you won't miss an episode. And while you're at it, visit www.chadcheese.com. Just don't expect to find any recipes for grilled cheese. It's so weird. We out!